Well, good evening. Good evening. Hello, everyone out in social media land. Um, Forgive the light behind me. It is shining through, but we thank God for the sunshine. I hope each of you are doing amazing. We are excited about tonight. It is our fifth session, and we have some very special guests that are joining us tonight. We've made a commitment, myself and along with Pastor Kurt. We've made a commitment for 12 months to show up in this space to help you with tips and tools and just knowledge and wisdom to help you to to be on the road to financial freedom. So we're excited that you are joining us tonight. We're going to bring our guest on in a few moments, but I want to shout out to all of those who are watching from Facebook, those who are joining us from Instagram, and those that are joining us from YouTube Live. We are glad that you are here. Listen, chime in, comment, share the broadcast. And so tonight, I'm going to go ahead and bring on Pastor Kurt to the stage tonight as he will introduce our special guest tonight. So I'm going to go ahead and turn it over to you.
Welcome once again, and thank you guys for sharing with us as we walk through the 12 months to the road to financial freedom. And one of the things Pastor Nedra and I have done, we've made a commitment to try to give you relevant information, professional information to help you get from where you are to where we all desire to be, which is a place of financial freedom, especially in our retirement years. We see what's going on in the economy. And one of the things we want to do in our working years is position ourselves for our retirement years. And many things we see other communities do, we're not privy to and taken advantage of simply because many a times the information has not been shared with us. The information was not taught to us. So one of the things we wanted to address and discuss on tonight is how do we position ourselves to have generational wealth? The Bible says a wise man leaves an inheritance for his children's children. And if you position yourself to be able to do that, then you position yourself to be able to take care of yourself as well. So if you have enough to leave an inheritance for your children's children, then you have enough for yourself. But many of us, as we live our life today and we deal with the economy that we're dealing with, many of us cannot even begin to imagine putting ourselves in a position whereby we would have enough resources, whereby we would have enough for generational wealth. And it's simply because information has not been provided to us for have us to think outside of the box, to have us to put on a new paradigm, and to have us to think differently. And one of the things that was made available to me by meeting the individuals that we're going to share with you tonight, is the mindset that other communities have and how they go about positioning themselves to establish generational wealth. And one of the things, one of the tools, financial tools that they use is insurance. Many of us just utilize insurance as a tool to minimize risk because that's the way it was presented to us from the time we became adults. If you drive a car, you know you have to have car insurance. If you have a home, you know you have to have home insurance. Many of us have medical insurance. We have life insurance. And it's primarily to minimize our risk, to minimize our liability if something goes wrong, right? But one of the things I've come to realize is other communities utilize insurance as an investment tool as well. Okay. And if you've never thought about it, if you've never been introduced to it, we wanted to do that on tonight. So we want to present on tonight Alan and Keisha Reed. Okay. They're principal agents and owners of Ksecure Financial Services, LLC. And for lack of a better term, they're owners of an insurance company. And I had the opportunity to meet them and have conversations with them pertaining to finances, let them know what we were doing. So we invited them on tonight to share with you and do a presentation to help introduce us to the mindset of utilizing insurance, not just to minimize our liabilities, but to enhance our lives as well. So, Alan and Keisha, I'm going to turn it over to you guys and for your presentation.
Thank you so much, Mr. and Mrs. Buckmeyer. Thank you so much for having us, excuse me, tonight on the podcast. My name is Keisha, and of course, this is Dr. Alan Reed. Now, I am the owner and the founder of our insurance agency, Ksecure Financial Services, and I've actually been in the insurance industry for over 10 years now. I've worked with State Farm for about 7 years. I've worked in sales, I've worked in retention, I've worked on the other side, which is the claim side. I've also worked with other various companies by the name of Aon, as well as Progressive, as adjusters as well. So I can kind of give you knowledge in regards to the products, as well as giving you a good basis and foundation to make sure that you guys have the proper coverages so that when a loss do or does occur, you guys are properly covered. So I do have that extra skill set as an insurance agency owner. Let me go ahead and have Mr. Alan Reed introduce himself as well.
All right. Hello, hello. So I'm Alan, otherwise known in Ksecure as Mr. Keisha, or as Keisha's administrative assistant. All right. So I've been blessed and fortunate and significantly blessed by God to be put in a position to meet my wife, and who is already in this field, and for her to educate me, encourage me, and direct me on that knowledge base that my community and a lot of other communities out here didn't have, right? Because growing up, everybody may or may not have already heard about life insurance. They may have had for my particular situation, we had the alpha guy that would come by. His name was Randy, and he visited everybody's family, and Randy became a part of it, but Randy actually didn't educate us. So Randy came out there and got moms, cousins, aunties, you know, saying nieces, nephews, grandparents, and made a lot of money off of us, but gave us the wrong policies, gave us products that wouldn't benefit us as a community. And my beautiful wife here decided that she wasn't going to let that happen to her community, because, you know, it's important to her. And I had gotten into healthcare because I didn't want the same things that happen in the medical industry to happen to my community. And so when we ended up getting together, we realized there are a lot of things that we can both bring to the table. And my wife always wanted to open up her own insurance agency because she's been diligent and hardworking and steadfast in making sure that the Christian community, the Haitian community, the greater Gwinnett County community always had somebody that they can always come to that will treat them fairly, educate them, inform them, and actually direct them, even if it's not with us, in a way that's most beneficial to that. So what today, what we plan on doing, all right, we plan on doing a general basis of, like, what is insurance, what is life insurance, and how can it be beneficial, right? Really basic information on life insurance, okay? And then what we're going to do is go over some of the products that we have, specifically a product called an IUL, which is an index universal life product that we feel would revolutionize generational wealth for the minority communities of any kind, because it is something that the majority communities have been doing since 1910, 1920. They developed these policies and things in place to allow the rich to remain rich and also protect their income, right? So as to piggyback off of what Pastor Kurt said, he's starting that, you know, a lot of times we talk about life insurance to mitigate the risk of losing your investments, the risk of losing all the things that you worked hard for. So we're still trying to mitigate that level of risk while giving you avenues and educating you on the ways in which you can protect your investments, but also grow for the future, leave legacies and things of that line. Okay. So we're going to start off. All right. And as I've said, once again, we're Ksecure Financial Services, and my wife Keisha Reed is the principal agent. Like I said, I'm also one of the agents underneath her. I will focus on as a including
Auto, and of course life insurance. And of course within that there's a lot of policies that we also offer, bonds, and things of that nature. But we are a full service line insurance agency, and we work with a variety of carriers. So if someone may not fit with Nationwide, we can go to Transamerica. If someone may not fit with Progressive, we can put you with Travelers. So those are the different options that we have as a full service agency to assist our customers.
Yeah, and I'm gonna without name dropping, we're like the price line of insurance or the kayak of insurance.
Expedia.
Right? Yeah, exactly. So we're running that brokerage aspect where like what makes us unique is that part other than it's minority owned and operated by my beautiful wife here, is that we give you the options of saying everything doesn't have to be cookie cutter. So we're customizable for people's needs. So the same amount of effort that that we use for corporate jobs and healthcare and in insurance, we're giving you the same amount of knowledge, same amount of expertise and experience, and we're customizing it in a mom and pop, in a private practice, in a way in which actually addresses the concerns of our community and the concerns in the county, and a lot of times just in the minorities as a whole or immigrants as a whole.
Yep.
Right?
We do also speak Haitian Creole, and we also speak Spanish. So we do have Spanish agents, we have Haitian Creole agents, and we have agents who also speak English. So we do try to attack a lot of different communities. We're like the Ghostbusters of.
No, we're not going to go for Ghostbusters, but all right. I think we understand. No.
Yes.
All right. So we're going to start with the presentation. So basically, like I said, what is life insurance? All right. So life insurance is a contract between an insurer, all right, and that pays a sum of money to a beneficiary when a specific individual passes away, pays a death benefit. Dad's or your grandparents' life insurance policies anymore. Previously, they only had two types. When life insurance first came out, you had two types of life insurance primarily. You had whole life and you had term, right? Primarily, whole life was a type of permanent life insurance policy, but they only had one option. So everybody associates a permanent life insurance with whole life. And if you were doing the Dave Ramsey approach, one of the things that they talk about is actually why you wouldn't want to do this is an IUL, right? Is an index universal life policy once again. And the reason that the IUL came into existence primarily was because of some of those questions and concerns, or one of those Dave Ramsey approaches that actually expressed all the negatives that people had heard about life insurance. So with that, just like any other company, if you get a whole bunch of bad publicity, you're going to start developing products and services that actually meet other people's needs. So in that, with all the negatives and the pitfalls and the limitations of these previous policies, then what happened is they actually customized and made a product that actually can benefit some people in a way in which a lot of times in our community we're ignorant about. Okay, so term or temporary life insurance is life insurance that's for a certain fixed amount. So sometimes 10 years, 20 years, 30 years. That's so term meaning temporary or for a specified amount of time. Mm-hmm. Permanent means throughout the life of the person that is insured. Okay, so like I said, we're doing an index universal life. All right. So with some of the goals that we want to discuss with this presentation is, if you're doing life insurance, can everybody see the screen we got going on right here? All right. So biggest thing that we do at Ksecure Financial, and when we're doing an evaluation, we'll go over this presentation with the hopes and dreams of saying that The more we get to know about you, the more we get to understand who you are, what you're looking for, the best we can actually customize approach to meet your needs. All right. And then once we meet your needs, all right, then we get to talk about, hey, what do you want?
Mhm.
Right? Because we're taught so much to work on needs, that it's always just a bare minimum. It's always meat and potatoes, right? That's all well and good. But if you take care of those needs, as you said, you save some money, you budget, you do your debt snowball, then you find out that you're going to start having money to actually invest. And then get to the point where we recognize that investment strategies and protection strategies are a necessity as well. Okay, because how we were taught, how we learned in the past, those things were luxuries for the rich, right? Those were the things in which that the rich people did. Don't worry about that. We don't need one of those, right? What we like to express to people is has never been the case, and that is no longer we're no longer left in the dark. We're no longer out here ignorant and blind. Okay. So we're going to say a lot of times we ask people like, what are your goals? Right? Would you like to leave a legacy, right, for generational wealth? Right.
Mhm.
So would you like to leave something for your immediate family in the event that you pass? Okay. Would you also like to have life insurance as an investment strategy that you can actually improve your lifestyle? Like you can actually change your lifestyle. You can go on your trips. You can do those things in which you want to do. Like, what about your lifestyle right now? Would you want to change in the future for retirement age? What are those things that you wish you were doing now, but you're saying, hey, I'll do that when I retire, right? We also have to make those plans for that. And future income. What happens when you're no longer getting a check?
Yep.
All right. Okay. So here's what we got. All right. So a lot of times we go in this the age you first received your first paycheck, and today, dum dum dum. All right. So a lot of times, most people really, really, really only understand that accumulation phase. Work, 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 work. All right. So we're in the rat race. We're in the hamster wheel. We're just keep on going in circles, keep on going in circles. A lot of times we think we're accumulating wealth. But what we actually do, if we don't have the things put in place, we don't actually accumulate any wealth. All right. We accumulate money, but no wealth. Okay. And then what ends up happening is as we get to after the accumulation stage, oh my gosh, we get to that distribution where we just want to spend all the money that we have. But a lot of times we have never done the math to actually know how much we'll need. How long do we expect to live? Right? How much of the things how much those things cost for things that we want to do in life? How often do we want to do them? A month or a year? Right? Do we want to do them with more people?
Yeah.
Right? Are you going to have any other supplemental or passive income once you retire from your primary check? All of those things which we would do is we do a financial analysis, right? And part of that financial analysis, just like anything else, is an assessment of what makes people unique. What are the goals in which each individual person has? Why are they important? What makes them special? And how can we be a blessing unto you all and help you achieve your goals while also educating you? So then you can take that information to your family, your friends, and make sure you tell them that Ksecure sent you. All right. So, all right. Let me say wealth of you. Time to put yourself first. All right. And here's that part where understanding your who's, your what's, your when's, your where's, your why's, asking your W's, because wealth also starts with a W. So you need to understand, like I said, who, what, when, where, why, and how. All right.
How much money can you save? Why are you saving money? And where do you want to put it?
Mm-hmm.
Okay, these are some really important things that we need to ponder across, because I know a lot of people are investing monies in 401ks, savings account that nets you close to 0% interest rate, probably 0.1, depending on the account. So where you put your money for investment is really, really important for your future as well.
Okay. So as you can see, we've got a really wobbly stool here. Okay. So with the thing about the wobbly stool, we use this as a thing to say the things that used to hold your foundation up, the things that were the actual structural components of what we saw as America in after World War II, right? So industrial revolution in America, you got baby boomer generation is now that age, right? To where you had savings, right? Everything putting in savings. You had pensions. That means when companies took care of their employees, right? And then you had the Social Security, right? The new great deal that Franklin Delano Roosevelt, we have all of this aid, right? You put money in, you get money out, right? Now, nowadays, these things have gone the way of being extinct, right? Like the dodo. Like you got like all these birds, all these animals that just extinct. You sometimes like kids nowadays won't even know what these animals are. All right, they're like dinosaurs. They're extinct. So these are the dinosaurs of some of these of our financial industry.
Yeah, a lot of corporate arenas, even the ones that I worked in, I was lucky enough to be with the company long enough to still have a pension. So I'm able to take advantage of my pension when I retire. Thank God. But literally the year before I left, they did away with that. So people who are coming into the company, being new hires or just, left the company, coming back after a certain period of time, they don't get to take advantage of a pension anymore. Personal savings, again, you're not netting a lot when you're putting your money in a savings account. It's good to save your money, but again, the vehicle that you utilize to put your money in is extremely important in regards to how much you're going to get back. Social Security, I'm 34, but I feel like by the time I'm getting, I get ready to retire, that also I hear is becoming extinct or will be non-existent at that time. So we need to think for the future. And unfortunately, a lot of us, our grandparents, our parents weren't educated, or I don't want to say weren't educated, but this information was not readily available to them in order for them to pass it down to us. So we don't know or understand the other aspects of investments outside of 401ks, and life insurance is a really big, important tool and vehicle outside of just for burial. I actually call life insurance in our agency love insurance. Love insurance. It's for the living. That's really what it is. But of course, your beneficiary will take advantage of that, at the time that you expire. But you can also, as the insured, utilize your life insurance for future income. And people don't know that, which is like the little cherry on top. And that's what we're going to go over with you today on how that can work for your benefit.
And with this, as we just said, with those options of the pensions, like I said, the personal savings and the Social Security, the things about it is, as we progress in this financial arena of the current United States, right? Things are up in the air. We have elections. There are things that will dramatically affect how our market, our money, things like that, right? So what we do is at Ksecure is like we do a customizable approach. We base everything off of who you are as an individual, as a family, as a unit, as a community, and find the best products and services for you. The thing about life insurance is that it's also very customizable. So there is no negative to, if you still have a pension, God bless it. And we can work with that as well, meaning that there is no negative to having life insurance while also having a pension. As you'll learn further out, talking about diversifying your portfolio, meaning that we want to have multiple different revenue streams. We want to have multiple different aspects of protection and multiple different aspects for retirement, funding, and savings. So there is no negative. I'm not saying that you don't have put any money in Social Security. We're just saying that, well, what happens if Social Security collapses? Or you're putting all your money into the personal savings. What you're doing is you're putting all your money in to get 1% or 0.1% return on the year. And the bank has a couple of million people putting their money in, and they use it however they choose, but they give you back 1%. So what we're saying is, you can still do those things, but now you actually have options for your money. And with those options, hopefully we can make some more informed decisions, and we can, like I said, educate, inform, and interact with the public in a way in which it's never been done before. Right? So we've got our fixed, we've got variable, and we've got indexed. All right, fixed is that old tried and proven method that's saying you're going to get what you're going to get. It's all you're going to get, which is that 1% from our savings, right?
Or even just the whole life policy.
Yes.
Those are usually fixed.
That means that they say you're going to get 1%, 2%, 3% for the life of the policy.
Right.
That's what they mean. It does not go up, it does not go down. That variable is what we would go traditional stock market to say if the stock market goes up, it's going up. Stock market goes down, it's going down. Up, down, the yo-yo effect, especially with our current, like I said, political kind. Our stock market always goes with elections. That's been the historical nature of the stock market. It's supposed to be variable. It's supposed to have that level of ebbs and flows, peaks and valleys, things like that. An index policy is that combination of both. It's where you actually are able to have some stop gaps, right? Some stops, some starts, some hold positions, to where an index policy, it revolves around understanding how the market works, right? But it bases everything off the market, but it's not attached or controlled by the market. And what we mean by that is that if the market goes up, great, the index goes up, okay?
And your money increases.
And your money increases. If the market goes down, the index stayed exactly where it was at the high part.
There's a floor. So with the index, it protects you in that way. You will never have less than what you invest into the product. You will never go down, unlike the variable. So of course you'll gain. Once the market drops, it stops. It kind of locks you into that price or that rate or whatever it is that you have at that time. Once it increases again and then it drops, it locks you down.
And these stop gaps are done at specific times. So throughout the years, these, like I said, we have the lock in place, the master lock. All right. And so we have moments with these types of policies and plans that will hold your position, all right, in order to protect your assets.
Yeah, exactly.
All right. So here's our traditionals, our moderns. So we have interest and credit. We've got, rate of return, things like this, participation rate. Okay. So when we say participation rate, all right, we're saying that if you were to, just like anything else, if you have a participation award, if you are a part of something, right? If you are actively contributing to something, if you have one of these IUL policies, this is one of our currents, or our previous ones for Nationwide. Nationwide is on your side.
Yeah.
Forgive the singing. So what they have is they have a 220% participation rate. All right. What that means is that if the market, all right, goes up 3%, okay, right, at that traditional, okay, if the market goes up at 3%, what Nationwide said is because you've invested with Nationwide, what they're going to do is they're going to double at 220% what the market does.
Yep.
All right. So if that market has an end of year increase of, like I said, of 7% down here, at that 220%, you're going to be getting 15.4%.
Right.
So what that does is it encourages, it's just like a promotion, right? Just like a discount sale at one of your favorite stores or any of your other products. They're going to encourage you to come in and buy with them. And then they're going to say, well, if you buy with us, hey, you get to save some money. You get to get the perks. With Nationwide currently, they've got 220%. I think right now maybe even 240. Yeah. 240% currently with Nationwide. So it's already gone up.
Yeah.
All right.
And of course, I believe this was in 2020 or 2021. The market did 12%, and some people who had their money invested in Nationwide and these products, they were able to get 26.4% on their money that they already invested into the life insurance policy. So, yes. And this is money that you can use later on.
And the thing about it is the average, unless you're a day trader or anything like that, the average person actually the average investor in the stock market usually makes around 10 to 12%.
Yeah.
Okay. And so if it got 12%, right, then they made 26. So they almost tripled. So this is Warren Buffett. Most of you all are familiar with Warren Buffett. He's Berkshire Hathaway. He's the man. He's Mr. Buffett, as they like to call him. So he is that guy. So his number one rule is never lose money. Okay.
Number 2, never forget rule number 1.
All right.
Okay.
So that means that the majority of the time in the older school model of investing, the biggest thing was like, don't lose, don't lose, don't lose, don't lose, don't. Caught up in the fact that, hey, well, how do we grow? Right. So in those moments, we had the 1%, like the fixed, the safety, right? So never lose money. That means going in the aspect of safety, right? That's our column over, right? If everything is about being safe, never lose money, right? He tells you all that while he makes money off of all the companies and stuff that you invest in him, and he does everything he wants to do with it. So it's his rule for other people,
not for himself.
right? Because you can't make billions by not losing money, because you'd have had to make billions earning it somewhere.
Exactly.
Right. So he's saying never lose it when you've got it. But most people don't understand that we're saying we have to accumulate it first. And in our communities, and generational. So with IUL, Index Universal Life Policy, what we have is the best of both worlds. Get the upside and the risk and all that stuff of variable on the right, and we get the safety and security and the protection of the fixed products on the left. So what that allows us to do is you have those mechanisms in place to lock you at a certain amount, right? So you don't drop down, that's our floor, while also not allowing you to actually have a ceiling. Right? And it is, like I said, it's based off of how well the actual market does, but it's almost like a mirror of the market, or it runs parallel with the market. Okay, so here we got the tax rate for highest and lowest earners, right? So what it shows is how much money you made and how much you were being taxed, pretty much, right? So you had in those years, woof, like I'd have hated to be between 1920 there. Then you got the Great Depression as that bottom route right there. And then once you get to the 40s all the way to 1980, they were taxing you
significantly.
Right? Me and my beautiful wife weren't in the workforce at that time. So a lot of you all that were, saying God bless you. Thank you for putting in that work so we can make a difference now. All right. But you recognize back in the, like I said, in the 70s and 80s, if you're working, that everything you got, you pay.
Yeah, it's taxed.
All right. So what an IUL benefit, one of the huge benefits of is we have tax deferred status, and some aspects of it are actually, are non-taxed.
Yep.
So all right. So we're going to show you these things. Click on.
This, of course, is how your money gets taxed. Reduce the impact of taxing when saving. You want to be sure to consider the effect that taxes can have on your income.
Yeah. So in the tax now parts, right? So you got saving accounts, CDs, banks, money market, stocks. So anytime you make some money in these in the stock market, they're going to tax you if you take it out.
Mm-hmm.
Right? All right. The tax later, 401ks, 403bs for the not-for-profit, IRAs, annuities, pensions, qualified accountants. So that means they allow you to actually accumulate your money in these policies, in these programs.
Grow, billions of dollars, and then they're going to tax you on it.
And you're going to get that tax rate of that 27%, that 30%, whatever your actual current rate is. They're going to let all that money grow without tax. And then when you want to use it, you get taxed.
Mm-hmm. And it goes back to the government.
Right. And then we have the tax nevers. Mm-hmm. So the Roth IRAs.
For those who qualify.
Yeah. Then we've got the cash accumulations and the insurance plans, which is what we're talking about today.
Right.
Then you've got your college plans, right? Which are like the Gerber grow up plans for college, right? The ones, all of those that we saw growing up. Right. So then we have long-term care, the proceeds, and then the chronic illness proceeds, and
which are also embedded in the life insurance policies. Again, people are not really aware, but if something were to happen and someone purchased one of these policies and you have a heart attack or you have a terminal illness like cancer, you can actually take funds from your life insurance policy, I believe up to 90%, depending on the actual diagnosis, to utilize that while you're alive. So again, a lot of people don't know this.
So we have living benefits.
That, but yes, these are called living benefits that are embedded in the actual life insurance.
So this is not your grandparents' whole life policy.
Right, or the burial policies that they used, that the alpha man used to go around and sell. This is an actual policy that you can utilize while you're still alive.
Mm-hmm. Mm-hmm. So we got those financial cornerstones. So we've already talked on those, right? So we've talked protection. Then we get the tax advantage, right? Then we get the safety, those mechanisms that we put in place. But it's that growth component that, like I said, that we've been missing that last corner, right? And the growth component a lot of times is what's been actually kept, from us.
Yes.
So that's what we work on today. So let's go. All right. So it means we have 80% of the American public put their money in banks, right? Or they have cash, or they have a safe, all right? Now, and these have a 1% return, right? You can put all this money in here and you're getting 1% on this.
All those years that you've been working, you only get 1%. How many years do you have to work to double that?
Mm-hmm. So we've got our index. There's the IUL. So that index universal life. The index is part of that market strategy we were talking about earlier, where it flows in conjunction with the market, but it's not a part of the market, which is what makes it stable, right? Which makes it controlled and protects you, right? The other part for this is the control. The U is the universal. So that means it's a type of life insurance, permanent life insurance. This is a combination of your universal life, an index plan, and a traditional life insurance. So what it does is the universal life allows you to adjust how much you can pay per month. It's a flexible premium. So just like everything else, you pay your premiums for your car insurance, your premiums for your health insurance. The universal life policy is one of the few policies that they created in the last 25, 30 years, which allow you to actually move money around into your policy. If you hit hard times, you get to say, hey, I can pay this minimum or I can pay more. And if you've been paying anything more, it automatically will feed back into it. So these policies are much harder to lapse. What previously used to happen is you get sold a policy, a permanent policy, and it lapsed because you missed a payment. 1 month, right? Some policies 2 months. But with the universal life policy, what it will do, it'll start paying in from, if you've been paying, say if your premium is $15, if you've been paying 25, all those times you pay 25, it'll start creating a fund to allow for you to have the policy still be in effect if you were to hit hard times. That is that control. That is that minimum maximum. It's flexible. You can also hold off on some payments and move them to further times along the line. Is that flexibility is what we like.
The funds are in that policy, you're able to borrow against that policy.
And the 59.5 rule, for those of you that may or may not, since you haven't done investing, the 59.5 rule is saying that you've put all this money into your 401k. All right. You've been doing it. You're working 30, 35 years at this company with this 401k. You started at 22. All right. You're 57. You retired for 35 years of service. You can't touch that money until you're 59.5.
Yes, or you will be
taxed. Right. So we're talking about sometimes 40%, 50% of the thing. There's a penalty.
Yeah, that you have to pay.
Yeah. So you put all this money in, but there's a significant penalty for you taking out the money that you put in. Yeah. Okay. So with the IOP, there isn't that rule. Once this particular policy starts to accumulate money, once that you are on that positive side, right? Once it starts to make you some money, then it's your money. You can borrow against it. You can actually take a loan out against it. You can do a withdrawal.
Buy a house, buy a car, pay for medical expenses, send your kid off to college. I don't know, want to go travel the world. Whatever it is that you want to do to your money, you can pull it out as you see fit.
And we're going back to what we were saying with that participation rate, right? So say you've got that policy for 10 years and it's been accumulating at that 26%. Maybe let's call it just 15%, right? So with those numbers for 10 years, you're getting a little bit more cash accumulation or cash value, meaning that how much money outside of that original death benefit is your policy worth, right? So, and those are what we're talking about, right? And with that,
of course, means the protection and legacy part, what you leave for your family, what you leave for your beneficiaries.
As my beautiful wife says, I love insurance.
Yes, it's love insurance. And then, of course, the living benefits, which is the, the benefits that you get to utilize while you're still alive. Chronic, critical illness, things of that nature. And, of course, you being able to borrow against the policy. Now, 80% of us have our money in the bank. 15% of us have money in our investment accounts, IRAs, more money, things of that nature. 5% of us, only 5%, have our money in actual investment grade life insurance.
And that's what we're trying to change, because most of the time it's a lack of actual, knowledge.
And you come up with your budget. You come up with how much per month that you can save. We call this more of a savings versus something that you have to pay or a bill, because this is money that you'll be able to utilize later.
Yes.
So I tell people, think of it as money that you're able to save or pay yourself is what they say. Hey, you're saving this money for the future, and that's what we call it. So you can come up with the funds or the amount here that you are able to save per month.
Yeah, and
instead of putting that money in the bank, stick it in your policy. It's gonna make you a lot more money than putting it in the bank.
And to piggyback of what y'all learned these last few months, if you're already learning how to do your own budget, you're already learning how to save some money, right? Part of that is understanding how you could utilize it to your best advantage. If we're talking about having, hey, like, oh, this is an emergency fund, that's perfect. Once you set up that emergency fund, and then going according to Dave, we're talking about, hey, how can we start investing for your future so you do not depend on anyone else, right? You don't depend on the company, you're self-insured, you're self-retired. Your retirement is from the hard work that you put into it.
Correct. And a lot of people may say, oh, I have life insurance through my job. Your life insurance that you have at work is not going to give you these benefits. They're not going to help you make money. And of course, once you leave your job, that policy stays with your job. You don't get to carry that with you. So the earlier and the sooner we start, the better it is for you. Even if you don't want an investment vehicle, just in general. The earlier you start, the better it will be for you because you'll be able to be qualified or get qualified for these products. Borrow something, it is tax-free using the code. This is what the code is that insurance policies utilize is the IRC 702.
All right, so the advantages, like I said, tax deferred earnings. Y'all can follow us. We can also provide this PowerPoint later on for archives if you all would like it. All right. There.
But tax deferred earnings, any growth accumulates on tax. Loans are not taxable. Again, it's all tax-free. Tax advantage cash withdrawals, right here with that code, you're not going to be taxed for that.
Yeah, and what we say is we have those things in place to make sure that all the policies that we provide for people fall under these tax codes. We have things in place with Nationwide that they automatically make sure that it falls within what the IRS deems as a
legal benefit.
There you go. So, all right, all right, and this tax-free. You've already talked about these. Okay, all right. Here's some of the books.
These are some of the books that we educate or try to advise our customers to look into when it comes to financial literacy. One of my favorite ones is this one, which is the How Money Works book right here. And I actually give that for free whenever I do bring up financial literacy and trying to set up for the future. This is something that I actually provide my prospects for free. I have them read it and they can pass it along to their children or to their friends or whoever else they feel like needs to hear this because this is really important. And they do, this book also explains it to in layman's terms. So if this is something that you're interested in, just drop your information in. I'll need your name, your email, as well as your phone number, and I'll just ship it to you for free. Yeah. And that's the How Money Works book.
Right.
Now, the biggest thing that we preach, of course, is the 7 money milestones, which you're already familiar with some of that in regards to some of the sessions that you've already attended with the Berkshire, excuse me. Number 1 is financial education. Become financially literate, find a financial professional. Number 2, protect. So you do need the proper protection. Protect against loss of income, protect against loss of savings. Number 3 is emergency fund. Save 3 to 6 months of income, prepare for unexpected expenses. Number 4 is debt management, bringing that debt down. The debt snowball that I'm sure you guys went over in regards to the Dave Ramsey method, but change spending habits, strive to eliminate debt. I educate on bringing down your debt and saving at the same time, because if you hit hard times, then you're going to have to max out your credit cards again. So if you're saving and bringing down your debts at the same time, you won't fall into that issue in regards to having a lot of debt. Cash flow, earn additional income, manage expenses. Number 6, build wealth, avoid the impact of taxes, losses, inflation, accumulate and grow assets for the future. Number 7, protect wealth. Create a will, guard your legacy. Please, please, please. That is very important. You want to avoid probate, avoid your family from having to go to probate, avoid sibling rivalry, trying to figure out what goes where. So if you create a will, everything's already set in stone. If something happens, you expire, which we all are going to expire. At least you have that written down prior to your expiration date, what you want and what you want to be allocated to your estate. And that is it. Thank you so much for having us. Of course, if you have any questions, any concerns, again, my information is in the chat. In order for me to ship you a book, please provide me with your name, your phone number, as well as your email address. And then I'll get that book out to you. And I'll also put in some little information as well that you may need, and you might see it to be deemed necessary.
And then and we're open for any questions, like I said, comments, things like that. Also, like I said, with our information right here, like I said, drop us a line, and we'll be able to answer your questions.
Excellent job. Excellent job. Thank.
Looks like he's frozen.
Am I back yet?
You're back. You're back.
Okay, cool. We've been having internet issues.
Yes,
so
major internet issues.
Not sure what's going on with Xfinity, but we want to thank them for sharing their expertise with us. And like I said before, many a times, as we approach insurance, I'm just familiar with the whole life and the term, not really familiar with all the different options that are available to individuals. And I'm so thankful that our paths have crossed and that we're able to glean their expertise from them to be able to share with us and expand our mind in terms of insurance, because like Keisha, I think, stated it, for those of you who have insurance with your job, you're many jobs today, you're paying for it. Number one, they subsidize it, but you're paying for it. So you're already paying. And number two, I remember when my wife and I was looking, and they were offering her insurance in her job. They were only offering her $200,000, and if we wanted I think they were offering her $100,000, and if we wanted any more than that, you had to pay extra. So if you evaluate what your company benefits are offering you, many times you're already paying. Part of the reason why I wanted to bring Keisha and Alan on is because they're giving you options. If you're already paying anyway, you want to get into a situation that's beneficial to you. So look into the programs that will give you a return on your investment, because if you're just paying on that job, and we all know when we're not working on one job for 35 years anymore. That stopped with our parents and our grandparents' generation. That's not happening. So you want to put yourself in a situation where you have the level of flexibility with your own finances to be able to control your finances. So I'm talking, hopefully if you have any questions for them, please put it in the chat. We'd like to address your questions now. One of the things that Keisha and Alan spoke to us about, many times we don't think about this in a family, but you guys remember you talked about the idea of ensuring the seniors in your family. If the family comes together as a family unit, ensure the seniors in the family, because we already know we have an expiration date. Not only can that cover your funeral expenses, but it sets up a financial vehicle in order to transfer generational wealth. Why don't you guys, while people are asking their questions, why don't you guys talk about that a little?
Yeah. Now, the age limit in order for you to insure a senior is 85. I don't think that's changed. So they have until they're 85, and I think that's a really smart thing. If we have an older relative or older senior, we can all put money together because it's going to be expensive. You're already, insurance is the law of large numbers. So, the underwriters, we know you're 85, you're closer to expiration than somebody who's 20, due to natural causes and things of that nature. So it's going to be expensive. So it's beneficial if everybody can come together, get a good policy, maybe $100,000 policy. It covers the funeral expense. And then of course, whoever put money in the pot, you have a couple of thousand to invest into your own vehicle or to, get property or whatever it is that you want to do with that. But that kind of sets you up for better, if that makes sense, because that person's going to decease, the person's going to die anyway. So that kind of sets your family up to be in a better position.
And so what we've done.
Go ahead.
I was saying, so what we've done, like specifically for individuals and families, right, is that we will cross and say, right, we're doing that financial literacy paperwork, we're doing that financial discovery, and in that discovery, we will also say like, hey, do you have any life insurance? Like, what would be how much would it cost for the house that your grandma's living in if it's not paid off, right? How much the bills that they currently are paying, if someone were to pass, is that taken care of, right? So we get to those questions first. We started getting to needs, and then we started getting into, once we understand that the need for insurance, then we started getting into that wealth building. A lot of times in the community, we haven't even taken care of those needs. So we'll say like, hey, one of the avenues is like insuring your elders, but a lot of times don't even insure your elders because we're not even insured at our age, right? So because we don't have those 35-year jobs, right? A lot of the jobs that we have don't even have benefits, right? Because we're contractors, we're entrepreneurs. So the things in which that benefit, that HR benefit onboarding summary that we would have gotten 15, 20 years ago, we have to do it ourselves. So now, like, we're not even getting 100,000 or 200,000 of a term from your job. We're not even having that conversation where it's embedded into your thing. So we need to insure ourselves. Then we need to say, kind of like, put in the airplane, you want to put the mask on yourself first before you help somebody else. As like I said, it's because if we're saying that life insurance is life preservation, just like that mask. So we want to make sure that before we start insuring our elders, we need to make sure that we insure ourselves, because if our elders are sometimes depending on our checks currently now because they did not have this education previously, right? So they weren't. We're taking care of our parents because our parents didn't know these things. We're taking care of our grandparents because they didn't know these things.
Yeah. And the way that would work, you would purchase the policy, submit the information, the elder or that person who's going to be insured, we call them the insured, will then go through underwriting process. Anybody can be the owner of the policy. If you want to insure your mother, she doesn't want to pay for it, you want to pay for it, you can be the owner of that policy, which means you have total control of what happens to that policy. If you want to borrow against it, that's fine. But it's still on your mother. She is that insured, or that asset that you're protecting, if that makes sense.
And there are multiple things to where there is no limitation on multiple policies.
Right.
So meaning that some people's like, well, I've already got life insurance, and we've had this conversation, but like, well, I've already got it. Well, is it enough to cover to pay the rest of your home off and those bills? Or are we leaving that for your children or your spouse?
Right. Or for a GoFundMe.
Right.
Whenever I see a GoFundMe, I'm like, I didn't do my job.
Yeah.
Because it happens, and that's really, and it really hit me hard when my 30-year-old cousin died about a year ago. He got into a wreck, wasn't doing anything, leaving the gym, and he died on scene, right on actually Scenic Highway on 124 in front of the custard ice cream place. He was leaving Crunch Fitness, and he got into a wreck. It was about 11 o'clock at night. He was leaving the gym, and he passed. But he didn't have life insurance. So that broke my heart because I sell insurance. And I'm like, oh my God. After that, I was just talking to everybody. Anybody who would listen, I'm like, please get something, anything. Because for him, the year, and it was $347 for the year age.
And
so the younger you start, the better it is. But a lot of times, people my age and 34, we don't see the
like, it's hard to tell younger individuals about like, hey, death. Like they think they're invincible.
Yeah.
Right. Mm-hmm. And what about to say is, death comes for us all. And if you know that, how about we go ahead and prepare? Because a lot of times I can customize, my wife customize a policy that at 21, you start paying on this policy at 21. I can set it up for you by the time that you're 35, you no longer have to pay on this policy.
Yeah.
And it's just making money for you. Right? I'd say we can, like I said, so we don't have to think about like the whole life policy. You previously would have to pay on that every month. It does not end, right? This, like I said, this is not your mom and dad's whole life anymore. With that U in the IUL, you actually get to be flexible on how much you want to pay, how long you want to pay, and then and how much you want to get in return. Like we can set those things up to say, if you want to only pay 15 years, we pay 15 years.
Yeah.
If you're 60 years old and you only want to pay for 10, we can say that pay for 10. Say, I'm going to retire at 70. And I've got, hey, I'm going to take all my check because I didn't do what I should have done, right? My daddy lived to 90. Hopefully I'll be 85. So we got 25 more years of growth at 60 years old, God willing. And you say, but if you put all that in there for 10 years, but like, hey, I'm making $2,000 extra a month that doesn't go to my bills, instead of me putting in saving, I'm putting in this policy. You can actually build something by the time that you're 70 that previously was unheard of, right? Because of the level of flexibility that we have with the premiums. And also for my situation, my mother had life insurance policy on us, but that alpha man Randy, he sold us 4 policies, so we only had 2% on a whole life policy. So, I'll be 40 this year, me personally, I'll be 40 this year. My mom's been paying on it for 40 years and it's made $1,000.
Yep.
Wow.
Oh, that's it.
And that's
years.
just a regular whole life policy.
And so because of that, and because of what Dave Ramsey said, and because of all the flack, that it was a terrible product. And it was good for the times, but that time it literally ended that next week. Right. So with that, now we've got all these other options that which are actually customizable and, like I said, and adaptable and fluid for our current situation. And with people like us who actually want to do to meet a need for people, that's what we enjoy to say, hey, what can you afford? I always tell people, how much can you afford? It's like, well, I can afford $100 a month. I say, all right, well, let's do it for 50. So if you can afford 100, let's do it for 50. Yeah. That way we know for certain that everything is going to be taken care of. And then I'll make the policy where it's usually about $25, $27 a month. That way, if you're paying 50, you're overpaying into the policy. And then so cash starts to accumulate, but also in lean times, if something happens, you've already paid into that policy. Mm-hmm. And then that allows you to have a little wiggle room for, like I said, for those, like for the storehouse, right?
Yeah, we have a couple of questions, but yeah, you guys, and I think the biggest takeaway I have is that insurance has changed. The fact that primarily, you have term and whole life, and that's, I think, the majority of people who are watching you probably are familiar with that, but weren't familiar with all the different options available. So if they just get that alone tonight was worthwhile.
Yeah, even the terms now have living benefits.
Yeah. A lot of the policies are not embedded with living benefits. Of course, it's good to ask questions just to make sure you're getting the correct policies, because we still have those outdated policies. But ask those questions.
We have internet issues. That's all that is.
Yeah. And just say, hey, what comes with my policy? I know it's a term, but do I get this? Do I get that? Because you do get chronic and critical illness embedded in those policies. And I wish I would have known that when my mom got policies about 12 years ago.
Our feed is doing something really crazy. It's coming in and out.
So what are some of those questions when you get a chance?
Can you hear us?
Hey there. Are you guys
I don't know if you can hear me. Our internet is
I
killing
can
us
hear
tonight.
you. I can hear you. They'll have to they'll your thing is on. They'll have to rejoin. I still hear you got something, a volume is still on. Whatever you're listening to, the volume is up. You have to turn it down.
Are you talking to me?
Yeah.
Okay.
So they'll
So
have to join because
yeah, go ahead. But the first question I saw was the is there affordable um, insurance
there
for
they are.
6-year-old? Yeah,
Oh
Oh,
my goodness.
we
Oh,
apologize.
It happens. So is there affordable insurance? Hard to tell. And
Yeah. So first question is, can affordable insurance for a 60-year-old?
Mhm. Yeah, it's a lot of things are affordable. We start off with the basic life insurance questionnaire, like just like anything else. Like, so I'm in healthcare as well. So whatever, like a basic screening, right? So we say whatever you got going on with you, that determines exactly what level of price you'll get.
right. Like what medications you may be on, what diagnosis you've had
You know,
within the last 10 years,
health status, stuff like
any
that.
surgeries that you had to undergo. Just a lot of different variables would dictate the price of the policy. So I can't say one size fit all. I know they're advertising all this one size fit all thing, but one size does not fit all.
But with our
And people
Mm. Locked up again? This is terrible.
yeah.
What's the second question?
Is the money you can access for long-term care or catastrophic illness money you have actually paid into the life insurance plan? They talked about this when they
Yeah.
were going through some of the plans that are available. So I don't know the answer
Yeah,
to
what they
that.
were talking about in the presentation, they were talking about the different aspects of taxation, right? When you put them when you either put your money in the bank or you put your money in a 401k or IRA, when you go to take that money out, uh, the level of taxation. So what they talked about is that the fact that you can when you invest your money in some of these programs, you're able to withdraw the money, uh, and you don't have the same tax liability that you would have if you did it with a 401k or IRA. So um, yeah, you would be taking the money out that you have put in, just like if it was a 401k or IRA. It's just you, or if you were taking a loan against, for some, you can take a loan against your IRA to buy a house, but there's only so many things you can do to be able to take money out. But we were just elaborating on the question of accessing money you put into one of the long-term plans. For
yes.
if you is the money you can access for long-term care or catastrophic illness money you have actually paid into the life insurance. Yeah. So we were just discussing that. We were talking about the tax implications about the other vehicles of like a savings or IRA, but with the insurance plan, I saw the slide where it said you didn't have the tax liability like you have in some of the other vehicles.
So, well,
Yeah, I
also what
remember.
we offer is the living benefits. What we have is we have riders. So we have additional things on the policy that actually pay into the long term care of the chronic illness. So that's actually a separate benefit from the actual cash accumulation. So we're saying that you can actually use a part of the death benefit. So we'll be
Yes.
specific. So if you've
It
got
comes from that.
if you got $500,000 worth of life insurance, that is the benefit amount, right? They got $500,000. Like what Keisha was saying is that on our riders, like with Nationwide and also with Transamerica at times, they allow you to use 90% of that 500,000 throughout the life of that policy.
Mm-hmm.
All right. So after a year or after 2 years, you can start using that living benefit if you were to come down with a condition or that they deem, if your ADLs, if your bathing, dressing, feeding yourself has been affected, right? And you have a doctor that writes that you've got this condition that falls under the chronic or the terminal illness aspect of it. And then that particular plan allows you to use 90% of that 500,000 while you're still alive. And what happens is, if you were to say pass in 10 years and you've only used 100,000, now your death benefit is 400,000 to your family, and you've been using 100,000 of it independent of any cash accumulation, no withdrawals, no loans, right? Nothing. We have those policies that are totally separate riders that allow you to actually utilize the death benefit while you're alive, and you're not borrowing anything.
Well, this has all been good information. Your contact information is on the page on the screen. Please, please, please. We brought this information. We brought Keisha and Alan to educate us, to give us more information on insurance. I know, because I learned a lot, I know it's been beneficial to you. So again,
so any of those questions or concerns, just print them out.
Well, no, what we want them to do is they have your contact information. If they need any further questions, or I would encourage, because we're talking about the road to financial freedom, and I would encourage individuals to reach out to both Alan and Keisha just to do the checkup, right?
You don't have to get anything, just to kind of see where you are.
Just an assessment.
And even the children, the kids going to college, if you don't have anything set in stone yet for them, now would be the time. All my children, even my little 1-2-year-old, he has something too. And his is going to build a lot more because of the longevity due to compound interest. So we can even utilize that later on, for him or for whatever it is that we need to use. And we're going to pay that until he's 20. Yeah, and then we'll have that policy forever. And it's $55 a month.
And we're setting up his retirement plan while he's 2 years old. So and then we'll only pay for 20 years. So by the time he's 50, he'll be, it'll be worth tens of millions.
Yeah. So it's $55 a month for his, but we pay $250. So we overfund it to make sure that it grows at the speed that we need it to grow in order for us to stop paying at 20 years. So there's ways to do it, but we educate you on all of that as well.
Yep. And everything is an assessment evaluation. And like I said, we're just willing to be a blessing and try to help people where they need it.
Yeah. So thank you so much. Thank you for having us.
Oh, it's our pleasure. It's our pleasure. And again,
amazing information.
The information is on the screen. Please, please, please take advantage of their expertise in this area. As you can tell, insurance has changed a whole lot from when Dave Ramsey talks about it and when other individuals talk about it. So we wanted to bring that information to you. I know we've had insurance on our kids as well. The oldest, when he went off and got a full-time job, he cashed out his insurance policy and he put a down payment on the car with the money. So it is beneficial. It is. Yeah, we saw it firsthand. So it is, and we still have the insurance policy on the younger one.
No, I thought those were saving bonds that Mother Dear had gotten for him.
No, we have insurance on both of our kids. Well,
I thought that was separate. I thought it was separate. Okay.
Diversifying. That's diversification. You can have more.
Because our kids used to get from the time they were born, my mother, birthdays, Christmas, stuff like that, she bought them savings bonds. So when they were ready to go to college,
which is great,
they had like $5,000 worth of savings bonds that they were able to put down on their college education. But I also had on each of them, like you said, just $25,000 worth of insurance just for in case of accidental death. And it was a whole life. And the oldest, like I said, was able to cash it out once he got his job and he needed his new car. He cashed it out, took the money and put a down payment on the car. So not because he got insurance with his employer. So I can attest to some of what you're saying. It is,
It's
and
very different.
the thing about what we don't take into account uh, in terms of generation wealth is time,
Mm.
right? The whole idea is being consistent over time. If you invest consistently
Mm-hmm.
over time and any vehicle giving you a decent return, like you were talking about,
Oh, yeah.
you will be able to accumulate some level of wealth. It's just we don't get into that mindset. We don't know what all our options are, or we don't have individuals like us, like yourselves, to help direct
Yeah.
us and steer us and give us the pertinent information so we can make a wise decision. So that's
The
why
knowledge. Mm-hmm.
we wanted to bring you guys
Yeah.
up to be able to just share the
Yeah.
knowledge that you have with us, your expertise with us. Um, and no, for those, some of you, I know out there, some of you are grandparents.
Mm-hmm.
You can open these up. You can start these for your grandkids. You know, they might not even be in
For the
elementary school.
grandkids. Yep.
You could begin to put things in place to,
Yep.
again, we're talking about leaving an inheritance for your children's children. How do you do that? You don't have to begin
Mm-hmm.
large. We're not talking about $1,000 a month. I think Alan talked about going down as little as $27 a month. You can start small, and just like the debt snowball. Well, the snowball works the same way. You start small and allow it to accumulate over time, right? And long after you're
Yep.
gone, right, your
Yep.
grandkids
And it's so
are
much easier.
your grandkids are benefiting from the wisdom that you had to be able to start for them.
Yeah.
So again, thank you both for sharing with us on tonight. And as always,
Mm-hmm. Thank
uh,
you.
I have a question before you sign off. So
Okay.
you had mentioned you talked about the 401ks. Of course, I know about the taxable up until you can't withdraw. Well, you can, but you get heavily taxed
Mm-hmm.
until you're like 59 and a half. Well, you mentioned something about the
Yeah.
Roth IRAs, and those are never taxed. So what were some of the, I guess, qualifiers for the Roth IRAs? I think you mentioned that you had to qualify for it, or maybe I was misunderstood.
Well, meaning that like some of the so with the Roth IRAs, depending on the company that's actually facilitating the Roth IRAs, they may have their own criteria for Roth
Okay.
IRAs. Right, so it'd be like that. And also the criteria is also you cannot overfund the Roth IRA. You've got a limit on how much you can actually put in there to invest each year. So once you hit that cap, so like I said,
And some of that is based on your income. So you can't make above a certain amount of income. If you're making $400,000 as an individual, a single tax filer, you wouldn't qualify for a Roth IRA, excuse me.
So
a
what
lot of that
about
falls within your income.
if you have a 401k currently and you're wanting to transfer, can you transfer that 401k to a Roth IRA? I think they're frozen.
oh, it also depends on, like you said, we also work with a lot of other financial professionals, and the gist will be every person is unique. So we would say,
Mhm.
hey, if you're making money in this, why would you want to transfer unless you're trying to use that as a lump sum to overfund the policy? So I won't not like a generic blanket statement, but the whole goal would be like if you've already invested this money and it's actually producing for you, because some 401ks actually do produce. Right?
Yeah,
Like some companies actually will
they are.
5%, and then they're putting in mutual funds in that company that are large
Mhm.
growth, and they're actually getting 12 to 17%. All right, for years, keep it in there, right?
Yeah.
If you're averaging good returns but that's also financial awareness.
Mhm.
Realize what your actual 401k is doing, like talking to the person that's managing it at your job, or if you're doing it yourself. So like there is no cookie cutter approach. That's what we're doing. We're customizing it for you. So if your 401k is doing well, let it do well. Save some money, budget, do the debt snowball, and we'll add this to your portfolio for retirement.
Now, there are tax implications when you do the transfer. If you did want to transfer your 401k into a Roth, there are tax implications that you do have to follow those guidelines, and you do have to report those funds that you're withdrawing as taxable income as you're transferring, if that makes sense, because it's still considered a withdrawal,
Does.
and you do have those penalties and things of that nature. it can be done.
Yes,
And you might lose more money doing that versus just leaving it in that vehicle and reinvesting somewhere else.
Yeah, I wasn't trying to scare anybody,
if that makes sense.
Because normally you're gonna have a penalty.
Just good information. Thank you.
As a capital gain.
Yeah.
But I have had people in the past because they've lose significant money in their 401k, leaving for working for corporations for over 10 years because of what the market has been doing. They've lost a lot of money, so they have withdrawn. They've taken those penalties and they withdraw that money and put it into a life product that they qualify for. So they'll take those $200,000 or $100,000 and just boom, do a one pay and just put it into a policy as a lump sum and just have that grow because it protects their money a lot more than the 401k.
The 401k is 100% dependent on the market.
Yeah. So, and again, I was trying to pick it up off of what Kurt was saying. The easiest way to, like, for grandparents and children are really easy to get approved, which is why I should say, for example, if I didn't have a whole life or IUL, I wouldn't put it on myself because I'm 34. So it's going to be expensive, and I'm going to have to invest a lot into that policy in order for me to get the return that I want to get by my retirement age. I have a child, again, he's 1. I put it on him. Well, he's 2 now. We did it, he was 1. I put it on him. It's $55, and with the longevity and with him being so young, he qualifies instantly, and then I can overfund that. So later on, if I even want to utilize it for myself, I can, which sucks because they're like, oh, you're using your kids as investment tools. Yes, I am. I can put multiple policies on him. I can have his own policy, and I can have my own retirement as well using my child.
So all you have to have is an insurable.
He is my insurable interest. So I do that. Instead of putting the money in the bank, $250 here, and if I have money from income tax and stuff like that, if I want to go ahead and boost that policy up for the year, I can do that as well. And all that is growing compound, depending on how the market does. I might get 12% for that year, right? So that's just all different ways and different aspects you can look at that. Because if somebody may not qualify for insurance, they can still be the owner of the policy and put it on somebody who qualifies. Of course, you have to have insurable interest. It's best if it's like your relative and so forth, but you can still put insurance on your family, on your kids, if you want to, because they're gonna get approved instantly, and it's gonna be a lot cheaper than it would if we put insurance on ourselves.
Yeah, and those are what we consider those investment policies, because, like I said, for the those are the ones that, if done well, those set your grandchildren, great grandchildren up significantly. So we did some numbers to where it ended up being like 87 million. By the time the child becomes 80 years old.
Yeah. And that's if we don't borrow from that.
Wait, 1, 2, 3, 4, 5.
You have access to borrow from that. But if you don't borrow from that and you just leave the policy alone and let it grow, it's going to grow compounding in that exponential way.
And like I said, and these are go ahead.
Yeah. And these are the things.
We're sorry.
Yeah, no, these are the things individuals need to know, because we don't think about starting with our kids when they're young, or our grandkids, and setting them up for success. Again, because it's less expensive when they're younger. We just focus on ourselves because no one taught us this. But thank you for sharing with us. Andrew, you can take them out, because we're getting, and again, we apologize for the Comcast and the internet issues. I see why podcasters have studios and things like that, because then you got to set up T1 lines, so you don't have.
There they are.
Yeah, you don't have.
You want the T1?
Well, I was saying I could see why podcasters, have studios and they set up with fiber optics and T1 lines, because you don't.
Oh my goodness.
Because you don't. I mean, we haven't had internet issues all day. I'm telling you,
I know. I've been on it working all day.
We've been on it all day working on it, and we haven't had.
That means we're doing something good. That's what that means. It's okay.
Yeah, we haven't had any issues. And as soon as we start the podcast, as soon as we start talking about finances, Comcast tried to act a fool. So
Comcast, they don't want you to know.
No, they don't. They just want you to pay.
We're just joking, Comcast. We're just joking.
Yeah, but again, thank you guys for sharing with us.
Thank you so much.
You guys have a great night. And again, their information is on the screen, so please reach out to them to get your assessment. Again, just get the information. Just get the information. Information is powerful. Information is key to help us um, position
It's a
ourselves to
great
be.
book.
And you got a free book. So
Yes, listen, I didn't see anybody chime in for tell us the name of the name of the book again is how
How
money
Money works.
works. So
Yes. How
what
money works with your sucker.
it just information. Just like the ins and outs.
Yeah,
Tells
I
about
have
the
my
stuff.
11-year-old because again, we have to start young. I have my
Yeah.
11-year-old reading this. And now she's talking to her
Yeah.
friends. I'm like, there was a career day. I'm like, bring it to school and talk to them about this. This is really good. You need to know this. And I wish I had that when I was in school, but she understands that now as an 11-year-old, the importance of money
Yeah.
and financial literacy. So she's getting that
Yes.
now at this age.
So
some of you,
people who have joined us from the beginning may have fallen off or may have gotten disconnected. I wanted to make sure. Yes, Erica Phillips is asking. Oh, Sean is saying they would like the book. Tell us again, Keisha, what they need to do in order to get that book. It is a complimentary book. That means that you do not have to pay for it. But I don't want to use free
No.
because somebody paid for
It
it.
is
Let's
complimentary.
somebody say amen.
Marketing
Right?
right now.
Somebody
It's
paid for it.
complimentary.
Okay. So what should they do?
All I need is your first and last name. I'll need your email address. So your first and last name, your email address, and your phone number. And of course, I'll need the address to ship it to. So I'll need that information, and then we'll get you your book. And it is complimentary. I pay for all that, shipping, all that good stuff. You don't have to worry about it.
and you just have to email Keisha.
And
You
then you'll
see
get
her
your
email address. You see her email address on the screen, right? Just email Keisha and get her your information, and you'll get a free book, a complimentary book.
Yeah. Exactly.
And so
Yep.
and some of you and some of you have young people who are just graduating. You have grandkids who are graduating, and you want to begin to get information like this into their hands.
Yeah.
Okay. You want them to be financially literate as they're starting out in college or they're starting out their first job. You want them to be financially literate, and this for them to have the information that we did not have. We want to be able to give the next generation a head start on the road to financial freedom.
Yes.
So, thank you, guys.
And that's all I ask. That's all I ask. With me providing you with the book, just pass it along to your family members, your friends, your children, whoever that you see can utilize the book and can benefit from the book. That's all I ask, is that you pass it along. Don't keep it to yourself. Share the information.
And Jackie,
Share
no,
the wealth.
you can't email me. You have to email Keisha. She's the one who
I
has the
think
book.
she was asking if while Keisha was talking, she put that up. So I just put the email there. And even if after the broadcast, they can reach out to me and I will provide your email address to ensure that they get a copy of the book.
Perfect. Thank you so much. Thank you. And if you guys have any other questions, concerns, just relay them to Mr. and Mrs. Buckmeyer, and they'll relay it to me, and then I'll provide you guys with the answers from there. Okay?
Awesome.
Great.
That's awesome.
Thank you for having us. This was
Oh,
great.
our pleasure. So we're going to continue on our next month.
Be blessed.
We're going to have for Road to Financial Freedom. We're going to have another guest speaker. We're going to continue on. We start this month. We were dealing with insurance as an investment vehicle, and then next month we're going to talk about investing. Because one of the things you have to understand, there's a reason that bank robbers go to the bank. That's where the money is. And one of the things we have to learn as investors, you have to know what your options are, but you have to know in the United States of America, where if you go out money, where do you go? And many times we become afraid of investing simply because of our level of ignorance. We're just not aware how to go about doing it. So we want to introduce you to investing. You understand stock, bonds, and all of these different vehicles that are available to us in terms of turning $1 into $1.25, $1.50, $2. If you can take every dollar you earn and turn it into $1.25, that's a 25% return in your investment. That's doing extremely well. So what we have to do is go from being consumers to becoming a revenue. I classify my family of revenue reducers. I'm the revenue producer. My family was revenue reducers. And what we have to do is learn how to become revenue multipliers, right? Take what you have and learn how to multiply it. So that's what we're going to be talking about on next month. And then always continue to support the broadcast as we try to bring on, get you the expertise in order for you to continue on the road to financial freedom. So you can always support us. Pastor Nedra is going to put up our Cash App. You can always support us just by Cash Apping us. It doesn't have to be a lot, but just for just so we can pay for the internet.
I know that's right.
I'm gonna have to call Comcast tomorrow and see if we
They
can get
are out of order. It's like,
plan.
what in the world?
Get a better plan, because obviously the plan that we have is not sufficient. So we're gonna have to invest in this internet thing to see if we can get a better plan. But we thank you. Yeah. Thank you all for your continued support. And I know, and again, thank Keisha and Alan. I know the information that they provided has been beneficial to you because it's been beneficial to us. So you guys, we're signing off. You guys have a great night. And until next month, we'll see you. And this is Pastor Kurt, Pastor Nedra, Keisha and Alan. We're signing off. You guys be blessed.
Have a great night, everybody. Thanks for
Have a
joining
good night.
and share the broadcast.